Jonathan Shield of Ashburton is also with us, and we are also being joined by Brian Jacobson of Wells Fargo Funds Management on the phone line. Gentlemen, welcome. Thank you very much for joining us. Steve's poll said 95% expect a rate hike. So I will assume that is a given. But Robert, let me start with you. How many rate hikes has the market discounted in 2016? Basically, what in the dot chart can literally shake the market up? Yes, Robert. Okay, well, we should be getting back to Robert in a minute. Lost connection, I think. Jonathan, same question to you. What's factored in? What can shock the market?
Yeah, I guess that's the key question, and are they going to change expectations for obviously the pace of rate rises going forward? So I guess if the statement is slightly more hawkish, if they're coming out with a statement suggesting the underlying health of the US economy is perhaps stronger than the street was expecting from a commentary perspective, then that could obviously cause a bit of extended volatility.
Okay, Mr. Jacobson, what would you think the market is already prepared for?
For that question, I think that actually the market is prepared for the Fed to effectively hike maybe 3 times between now and a year from today. Now, a key thing, though, is I think whether or not that takes place in 3 distinct steps. So if the Fed raises its target by 0.25 percentage points, perhaps every other meeting between now and December 2016, or if it does something a little bit more unconventional. Let's face it, we're emerging from this period of very unconventional monetary policy, and so I would not be surprised if the Fed decided to tiptoe its way to slightly higher rates by perhaps hiking by only 0.125 percentage points every meeting. So that way, we wouldn't necessarily be stuck in this limbo of thinking, are they going to hike at this meeting or the next? They could actually just kind of proceed every meeting at a very steady pace that would reiterate to the markets that it would be a very shallow path. And I would view that as not only being prudent by the Fed, but also very much welcomed by market participants.
All right, let's get Robert into the conversation as well. So the same question that we've been asking other experts, Robert, do you expect a very clear guidance about the future course that the Fed might take from Ms. Yellen tonight?
I think 2 observations. I think the first observation is if they do not raise interest rates this evening, actually I think that they would cause a significant jump in market volatility. So I think in a way the Fed has got itself into a corner where it really does have to raise rates this evening. In terms of the clarity of the statement, I would assume, because there is so much pressure on the Federal Reserve, that we will get a clear statement, and I think that that's going to be a very moderate statement. And I concur with some of the other comments that have been made already, which is that by the end of next year, I think you have to assume a Fed funds rate probably between 1% and 1.25%, i.e. that the pace of Fed funds rate increases is going to be very moderate, and also the quantum is going to be very small. And that's totally justified against a background where inflation is only going to creep up slowly. In the near term, the inflation numbers are going to be very weak again. That's headline inflation. And where I do think that growth is not going to be very exciting. I think next year we're in a period where at best growth is going to be about 2.5%.
Okay. Well, actually, let me get back to Brian with a counter question. Brian, you said that it's also possible that they will do 0.125 and tiptoe their way at that pace. The market's prepared for more. So if 0.125 is what the Fed does today, how will the markets react?
I think that it could actually be a very positive thing for the markets. And so if Janet Yellen is going to attempt to surprise the markets and the market, the economic participants to the more dovish side or to the positive side to say that, we are prepared to hike. We think that we're ready to start the normalization process because the economy is strong enough. But we want to effectively pre-commit ourselves to a very shallow path of hiking. That could be a very visible and I think a very credible way for them to do it. Right now, the effective federal funds rate, even though the window is between 0 and 0.25 percentage points, it's been fluctuating around about 0.125, 0.13% anyways. So if they were to move it up just 0.125% more, just shift that window up, the effective federal funds rate would be around 25 basis points. So I think that it would be a nice small step, but very clear dovish language from the Fed saying that they're not worried about any imminent increase in inflation, and they're not worried about geopolitical events that could somehow impinge on future economic growth in the United States. I think that could be taken as a very positive signal.
Jonathan, let me just get your take here, because this is a bit of a minority view. Most of the experts have been talking about at least a 0.25% hike. In case it is less than a 0.25%, will the market take it, as our speaker just described, or do you think it'll cause some unease and therefore some more volatility?
No, I would certainly agree with your other speaker that I think markets would view that extremely positively. Obviously, if you look at investor positioning, then particularly in the US dollar and the commodity complexes, I think any policy action such as just suggested, I think that would potentially lead to a fairly large short squeeze in some of those asset markets, and therefore would be very positive for risk assets.
All right. We have you on a bad line, Jonathan. We'll try and fix that. But we have our own